My name is Michael Hughes and I've been the investment and economic consultant to Fiducia for the last 10 years. Well, last year was probably the most challenging year for investors for some time. If you look back in history, you will never find a year where virtually every asset class that people can invest in fell in value. Now, we've had big falls in stock markets before in 1929 and 74 and indeed 2000. But there's always been other places to go to invest in that made money, not in 2018. And the reasons for that, I think, were twofold. The first is that we were ending a monetary era called quantitative easing, money printing, which we'd had for 10 years, never seen it before. It was quite an exceptional period. And by and large, it provided quite a big boost for stock markets worldwide. Well, that started to come to an end in 2018, and indeed it will continue to unwind as we go into 2019, 2020. So that was the first big change that people had to take into account. And the second thing is that they had to start penciling in the idea that there was going to be some degree of economic slowdown. We've had probably one of the longest economic recoveries on record, not been the strongest, but it's certainly been one of the longest, dating back to 2009. And so it was only a matter of time when you saw that momentum of economic growth turn down. And that started towards the end of the year. So those two things provided quite big headwinds for markets, and they took their toll in terms of investment returns. Now, if we look into 2019 and indeed beyond, because stock markets tend to look out 2 years, they don't just look out a matter of months. Those two themes are still quite relevant. Quantitative easing is coming, or has come to an end in the United States, it's coming to an end in Europe, and it will come to an end in Japan, probably by 2020. So as we go into 2020, you will find that all the major monetary authorities won't be printing money. They will be in a much more restrictive environment. And we've, again, never been there before. So it doesn't pay to be too clever. Central bankers aren't clear quite how that's going to unfold and the impact it's going to have. And so from an investor's perspective, it's as well to be just a little more cautious and to say, well, what are the things that we actually do believe in terms of the long-term economic growth? What are the themes? What are the sectors? What are the industries that we can look forward to? And put our investments very much focused on those. And the other thing is that this economic slowdown which has started, people are concerned that it will end up being a global recession. I'm not that worried yet about there being a global recession. Firstly, the risk of it happening is more likely in 2020 than 2019. And the reason I say that is that that is the year where the big tax cuts that have come into the United States end, and you start getting small tax increases as we go into 2020. So that stimulus goes away. So that's when the danger signs for a global recession are going to be on board. But the three things that I think are valid to look at this year are firstly what the US central bank does, because what happens to US interest rates matters in terms of the rest of the world, particularly the emerging part of the world. They've said that they will continue to raise interest rates, but actually, given the slowdown that has begun, I think that risk is possibly a little less than it was a little while ago. The second thing which I think is valid to look at is what's happening in China. Now, China now occupies more, has a higher share of world trade than the United States. So whereas in years gone by, we looked at the US economic cycle to have a guide to what's going to happen to the global economy, now it's more relevant to look at China because of its size and because of its relevance to global growth. Now, in China, there is a slowdown coming. They have got problems, and they're also fairly limited on how much new stimulus they can actually do. Interest rates are pretty low. They're 1.5%. So there isn't a lot of scope to reduce interest rates. And because they've been giving quite a big stimulus to their economy in 2009 and again in 2016, their debts are pretty high. So it's very hard for them to increase those debts. But there is some scope for them to give a degree of support. But the biggest thing for them is if the US and China can do a trade deal and take away that risk. And the final thing that I think is relevant for this year is what happens to the oil price. Now, last year, towards the summer, people were getting concerned, when the oil price was about $80 a barrel, that it was on its way to $100 and be pretty disruptive. It's now come back to something around 50, and I think somewhere between 50 and 60 is probably where it's going to settle. If that is true, if that's what actually happens, then it will provide a degree of support to those economies that import a lot of oil, and it won't threaten the living standards of everybody who depends on oil in one way or another. So provided we have a reasonably stable oil price, provided that the Federal Reserve in the States doesn't raise interest rates very aggressively, and provided China and the US does some degree of deal, then I think that the outlook for this year is okay, but it's not brilliant. And as I say, we have to bear in mind what may be happening the year after in 2020. So whereas the stock market correction that we have seen towards the latter end of 2018 has taken what had been quite high valuations back to something which is nearer to a fair value, they're not cheap. So it's not a question of saying the US and other stock markets are now cheap and that we can take the risk of going in. What I would say is that if we look beneath the surface of these markets and look for the new industries and the new companies that are coming through, and actually new technology is really quite exciting. You know, we've been talking about battery cars for 20 years. Actually, the next 2 or 3 years, the number of battery or hybrid cars that are being sold will exceed those of traditional vehicles. So it is a new era for transport. Same with robotics, same with the genome project in terms of healthcare. Lots of companies who've been investing for 20, 30 years are now starting to bring a product to the market. If we can identify the companies and the funds that specialize in those areas, they're the ones that will generate economic growth longer term, even if we have an economic slowdown that extends into 2020. So as we go into this year, it's a question of being careful, but not hugely cautious. Keeping a close eye on what are the right industries and sectors to go into, and not being prepared to panic. Because I suspect, actually, that we'll come out of 2019 being a little happier than we've gone into it. Now, there's one exception to that, and that's what's happening in the UK. Because of, not just because of the Brexit vote, but because of the consequence of Brexit longer term. And the one thing that stands out for me here is that because British companies have, for the last 2 or 3 years, really not known quite what to expect, they've built up a fair amount of cash. In fact, at the end of 2018, British companies had built up cash equivalent to nearly 37% of the size of the UK economy. And that's much higher than it was a year ago and a lot higher than it had been 2 years ago. So if you get some degree of resolution, whatever form it may take, and those companies then decide that the investments they've held back on, they are now prepared to release, that can actually give quite a big boost to the UK economy in a way that the stock market is not currently beginning to believe in. Whether it believes it later in 2019, we will see. But there is some firepower there, which doesn't relate to the central bank cutting interest rates or there being a tax boost. It's not about policy. This is about companies in the UK that have held back because of this uncertainty. And once that uncertainty goes or starts to reduce, then I think they can give quite a big boost. So the UK is an interesting market for us, and one that if we get the right path of policy, the right resolutions, we might be looking to take a higher proportion of our funds in the UK.